How do dividends work? A corporation pays its shareholders a dividend, which is a portion of its profits and retained earnings. When a corporation makes a profit and accumulates retained earnings, those funds can either be invested back into the company or distributed as a dividend to shareholders. The dividend yield is calculated by dividing the annual dividend per share by the share price. How dividends are paid: the amount of a dividend is calculated per share, and it must be distributed equally to all shareholders in the same class, common, preferred, etc. The board of directors must approve the payment. The payment date is the day after the dividend is proclaimed that it will be paid. How it operates in steps. 1. The business makes money and keeps its retained earnings. 2. The management team chooses to distribute some excess income to shareholders, instead of being reinvested. 3. The anticipated dividend is approved by the board. 4. The business makes the dividend public, the value per share, the date when it will be paid, the record date, etc. 5. The shareholders receive the dividend. Dividend Illustration. An illustration from General Electric's, GE, 2017 financial statements is provided below. GE declared a dividend per common share of 84 cents in 2017, 93 cents in 2016, and 92 cents in 2015, as shown in the screenshot. Different dividends. Dividends come in a variety of forms that a business might give to its shareholders. The most typical sorts that shareholders get are listed below, along with a brief description of each. Types consist of: the most typical sort of payment is cash, which refers to actual money paid by the company to its shareholders. Typically, the payment is made electronically, through wire transfer, although it is also possible to pay with a check or cash. Dividends paid in stock are distributed to shareholders by issuing more company stock. These are distributed proportionately, according to how many shares the investor already holds. A business is not just allowed to distribute money to its shareholders in the form of cash or stock. Although it is uncommon, a firm may also pay out other assets, including investment securities, tangible property, and real estate. A special dividend is one that is paid in addition to the standard dividend payout schedule of a firm, i.e., quarterly, annual, etc. It usually happens when there is too much money on hand for whatever cause or another. Common refers to the class of shareholders, common shareholders, not to the amount of money being paid out. The term preferred also designates the class of shareholders who will receive the dividend. Options, warrants, shares in a new spin-off firm, and other uncommon financial assets can also be paid out as dividends.